So, you started your business. You set up an LLC because someone told you to, or because it seemed like the right move. Maybe your CPA recommended it, or maybe you read about it online, and it probably was the right move at the time. But here's the thing. The entity structure that makes sense when you're building a business is not always the same one that makes sense when the business is profitable. And most business owners never revisit that decision. In this video, I'm going to walk you through 3 specific indicators that you may have outgrown your LLC, what the math actually looks like when you consider an S-Corp election, and what to watch out for if you decide to make the switch. I'm Matt Losanno with Cinder Wealth. Quick disclaimer. This is educational only. Entity structure decisions have real tax and legal consequences specific to your situation. Always work with your CPA and attorney before making any changes. Let's start with the basics because there's a lot of confusion about this. An LLC is a legal structure. By default, a single-member LLC is taxed as a sole proprietorship. A multi-member LLC is taxed as a partnership. In both cases, your net business income flows to your personal return and the entire amount is subject to self-employment tax. Self-employment tax in 2026 is 15.3% on the first roughly $185,000 of net earnings and 2.9% above that. That is your Social Security and Medicare contributions, both the employee side and the employer side, because as a self-employed person, you're both. Now, here's where the S-Corp election changes things. When you elect S-Corp status, you split your income into 2 buckets. Salary, which is subject to payroll taxes, and shareholder distributions, which are generally not subject to payroll taxes. So if your business nets $400,000 and you pay yourself $150,000, you pay payroll taxes on $150,000 instead of $400,000. On the remaining $250,000 in distributions, you're not paying that 15.3% payroll tax. And at that 15.3% payroll tax, it's a significant number. On $250,000, that's almost $40,000 a year just in payroll tax savings. Now, there are costs. Payroll administration, potentially a separate business tax return, and you need to make sure your salary is actually reasonable for what you do. And we'll come back to that. But for the right business owner, the savings far outweigh the costs. Indicator number 1, your net profit is consistently above $50,000 to $80,000 per year. That's roughly where the math starts to work in favor of the S-Corp election for most single owner businesses. Below that threshold, the administrative costs of running payroll, filing a separate business tax return, and maintaining the S-Corp formalities tend to offset the self-employment tax savings. Above it, the savings start to really outpace the costs, and that gap widens significantly as your income grows. Let's look at this simply. Say your business nets $100,000. As a standard LLC taxed as a sole prop, you pay self-employment tax on the full $100,000. So that's roughly $15,300 in tax before the above-the-line deduction. With an S-Corp, you can pay yourself, say, $60,000 salary, pay payroll taxes on $60,000, take $40,000 as distribution. The self-employment tax is now on $60,000, and that's roughly $9,200. Saving $6,000 annually, even with a couple $1,000s of an extra administrative cost, you're still ahead. Now run that same math at $300,000 in profit, and the savings are substantially larger. The key word is consistency. If your profits swing dramatically year to year, the S-Corp structure requires a fixed salary regardless of how the business performs. That is something to factor in. Indicator number 2. You've maxed out SEP or the Simple IRA and you want to contribute more to retirement. Here's something most people don't realize. The S-Corp structure unlocks more powerful retirement options. When you're a W-2 employee of your own S-Corp, you can set up an individual 401k as the employer. In 2026, that means up to $24,500 as the employee contributions, plus up to 25% of your W-2 compensation as the employer contribution. Combined, you can potentially reach $72,000 per year, plus an $8,000 catch-up if you're 50 or older. But here's the layering opportunity. If your income is in the $400,000 to $7,000 range, you can add a cash balance plan on top of the 401k. And depending on your age and plan design, that could mean deferring $200,000 to $300,000 per year on top of your 401k contributions. A lot of LLC owners think the SEP IRA is their only real retirement option, and it's not. But accessing the better options requires the right entity structure. So if you're sitting in a SEP and frustrated that you can't defer more, you might just have the wrong plan, and that's where the conversation starts. Indicator number 3. You have a clear, consistent income and a well-defined role in the business. The S-Corp structure requires you to pay yourself a reasonable salary, And we covered this in detail in our S-Corp salary video, but the short version is the IRS expects you to pay yourself what you'd have to pay someone else to do your job. If your income is consistent and your role is clear, documenting that reasonable salary is straightforward. You have data to support the number. But if your income swings dramatically, if you are doing 10 different jobs that are hard to compare to a market rate, or if the business is very early stage, that S-Corp structure gets harder to defend and harder to administrate. So this indicator is really about timing. The S-Corp works best when the business is profitable and stable, your role is defined enough to benchmark a salary, and you have or are ready to set up payroll, and you have a CPA who understands S-Corp compliance. One thing I see all the time, business owners elect S-Corp status and then pay themselves whatever feels right. Too low and you invite IRS scrutiny, too high and you eliminate all the benefit. And if your financial advisor hasn't seen your tax return and your attorney hasn't looked at your operating agreement since you made the switch, nobody's making sure they're still working together. That's the coordination gap that costs people money at this stage. Let me recap the 3 indicators. 1, your net profit is consistently above $50,000 to $80,000 per year and it's growing. That's the range where the math starts working. 2, you've maxed out your SEP or simple and want to contribute more to retirement. The S-Corp allows us to adjust our W-2 salary, which opens the door to optimizing the 401k and in some cases a cash balance plan. And 3, you have consistent income and a clear defined role. The S-Corp requires a defensible salary, and that's easier when your business is stable. If all 3 of these describe you, it's worth a conversation with your CPA about whether an S-Corp election makes sense for your situation this year. And if you do make the switch, make sure your CPA, your financial advisor, and your attorney are all in the loop. The entity change affects your retirement plan options, your operating agreement, and potentially your estate plan. Those pieces need to be coordinated. Please subscribe for more content on tax strategy and business structure for growing businesses.